Think about your wallet, your phone, every single financial decision you make. How much trust do you implicitly place in your bank every single day? From a simple debit card swipe to, that huge mortgage for your first home. Our financial lives are just so deeply intertwined with these institutions. But have you ever really paused to consider the ethical backbone or, yes, sometimes the unfortunate lack of it that underpins this whole vast banking world?
Welcome to the Deep Dive. Today we're plunging headfirst into banking and its ethical landscape. Our mission is to explore that really intricate world where finance, this massive force, meets the, well, often tricky terrain of ethics. And we'll unpack how this impacts you directly, whether you're a customer, an investor, or maybe even someone working right inside the financial sector. Exactly. And our goal for this deep dive is really to try and cut through the often overwhelming complexity you find in the source materials. We want to get to the core functions of banking, definitely, but maybe more importantly, the ethical responsibilities that should underpin them. We'll also look at the systems that are in place, or frankly, sometimes noticeably absent, that are supposed to ensure integrity in this, constantly changing industry. Think of this as your shortcut, maybe, to getting really well informed about the moral compass of money.
Okay, yeah, let's unpack that then. When you really boil it down, why do banks even exist? Most people just think, oh, it's where I put my money or where I get a loan. But it's got to be more fundamental, right?
Oh, absolutely. At their most basic level, banks are financial intermediaries. They're essentially the bridge connecting people who have surplus funds, your savers, with those who need capital, your borrowers. So, your savings might actually be part of the pool that funds someone else's mortgage to buy a home or maybe a small business loan. It's not just deposits and loans. It's about facilitating that flow of capital that's just essential for economic activity.
That makes perfect sense. So they're kind of the grease in the economic machine, you could say.
Yeah.
What else really defines their core purpose?
Well, beyond that intermediation role, they're absolutely critical for payment systems. They enable almost every transaction we make, right? From online shopping to business payrolls. And of course, there's the safekeeping aspect, providing secure places for your money and valuables. But they also offer risk management tools, things like insurance products or lines of credit, to help individuals and businesses navigate financial uncertainties. And importantly, they manage wealth, offering advice and services that help people plan for their future. All these functions together aren't just about individual transactions. They really form the bedrock of economic growth and stability. And what's fascinating here, I think, is that to really grasp a bank's wider responsibilities, we need to look beyond just its direct clients. We need to think about its stakeholders. Now, when we talk about a stakeholder, we basically mean any person, group, or organization that can affect the company A and D be affected by it. Sounds straightforward maybe, but the implications are actually pretty profound.
So it's not just the shareholders, the people who own the bank. Who else is in that stakeholder bucket?
Exactly. It's much broader. You've got external stakeholders like the government, regulators, even the media. Internally, you have the directors, the employees, and then you have what we call connected stakeholders, your customers, your suppliers, and even the communities where the bank operates. So the stakeholder approach basically means that when a bank makes decisions, it's ethically obligated, really, to consider the interests of all these parties, not just maximizing profit for shareholders. And if we connect this to the bigger picture, well, it explains why a bank's failure to consider, say, community impact or employee well-being can lead to huge public outcry, even if those decisions seem profitable initially. It's all about that ripple effect of trust.
Right. And trust is it's paramount in banking, isn't it? It's like the invisible currency that makes the whole system work. It helps transactions run smoothly, minimizes fraud, and frankly, it's what really enables ethical banking. You're trusting them to act with integrity, offer fair terms. Ultimately, trust isn't just a nice to have. It's the absolute foundation for innovation and growth across the whole financial sector. But here's where it gets really interesting. What happens when that trust just shatters?
Oh, we've seen it happen in very public, very damaging ways. I mean, take the HSBC money laundering scandal. Their failure to adequately combat money laundering didn't just lead to massive fines. It caused this deep loss of customer confidence and reputational damage that took years, literally years, to even start rebuilding. It was a fundamental betrayal of the trust placed in them to uphold basic legal and ethical standards.
And Wells Fargo, that was another huge one, wasn't it? That really hit the headlines.
Absolutely. The Wells Fargo account opening scandal was almost a textbook example of internal pressure, just completely distorting ethical behavior. Staff were pushed so hard, to meet these incredibly aggressive sales targets that they ended up opening unauthorized customer accounts. Millions of them. This was a direct violation of customer trust. It caused real financial harm. And yeah, it resulted in huge fines, lawsuits, and a tarnished brand that frankly still echoes today. It really highlighted how even major institutions can completely lose their moral compass under intense internal pressure.
So to try and prevent that kind of breakdown, you have frameworks put in place. One really key example is the Asian Institute of Chartered Bankers, the AICB, Code of Professional Conduct. It's specifically designed to build and maintain that trust. Now, instead of listing every single principle, maybe we can focus on one that really speaks to these scandals: integrity.
Yes, integrity is all about being honest, being trustworthy, and fundamentally never misleading others. In that Wells Fargo case, the lack of integrity was just blatant, wasn't it? Employees were being dishonest with customers, opening accounts they never asked for. It wasn't just illegal. It was a fundamental breach of trust that just destroyed the customer relationship. The AICB code tries to embed this principle deeply, making sure bankers act with straightforward honesty in everything they do. It's a crucial reminder that just following the letter of the law isn't enough. That spirit of honest dealing is absolutely vital. So, okay, how do organizations actually put these ethical and professional standards into practice? Because, it's not enough to just have a code pinned on the wall, right? One of the most critical steps, I think, is to provide continuous training and education.
Why is that so crucial? I mean, don't employees generally know what's right and wrong?
Well, not always, especially when you get into complex financial situations. Training helps employees not just understand what the ethical guidelines are, but critically, how to apply them in those real-world dilemmas they face. It gives them the tools to spot ethical risks and know how to respond. But another absolutely critical step is for management to lead by example. If the leaders themselves are cutting corners or pressuring staff towards unethical behavior, no amount of training is going to fix the underlying culture. That tone at the top really does set the standard for ethical behavior through the entire organization. These aren't just, tick box exercises. They're about creating a living, breathing, ethical culture.
That's a really good roadmap. Let's try and apply it. Let's use a real-world type scenario to put this into perspective. Imagine Aisha, she's a loan officer at a bank, and she's facing intense pressure from her manager to approve a pretty risky loan. Now, the twist here is that her manager has a personal relationship with the client, and approving this loan would directly violate the bank's own established policies. It's a classic ethical tightrope walk, isn't it?
It's absolutely classic. In Aisha's situation, the principle of integrity is immediately challenged. Approving that loan, despite clear red flags, would be dishonest, misleading to the bank, its depositors, everyone. And equally important is objectivity. She needs to remain free from bias, free from that undue influence coming from her manager's personal connections. This isn't just about Aisha's personal ethics. It's about the bank's entire ethical framework potentially failing if it can't withstand that kind of internal pressure. And the consequences for Aisha are quite stark, aren't they? They really illustrate the practical side of these frameworks. Approving the loan could lead to significant financial losses for the bank if it defaults, sure, but it also damages its reputation. But maybe more subtly, it corrodes the bank's internal ethical culture. It sends a message. Rejecting it, while it might strain her relationship with her manager, upholds the bank's ethical standards and protects its financial health in the long run. And this also ties into that broader systemic ethical concern of too big to fail, right? Where the perceived unfairness of taxpayer bailouts for huge institutions can, maybe unintentionally, encourage excessive risk-taking. That makes ethical dilemmas like Aisha even more acute, even more pressured within the system.
So what does this all mean when we're trying to make those really tough calls? It really highlights that ethics isn't always, black and white. There are often multiple lenses you can look through.
Exactly. And first, it's probably helpful to distinguish between morality and ethics. They're related, but not quite the same. Morality tends to be about those individual or societal principles of right and wrong, often shaped by upbringing, culture, religion. Ethics, on the other hand, is more about applying those moral principles to specific professional conduct. So, for instance, a barrister is ethically bound to give the best possible defense to a client, even if they personally believe that client is guilty. That's their professional ethical duty. Similarly, a banking employee might personally disapprove of a client's business, maybe it's a gambling company or something, but they still have to act professionally and stick to the bank's ethical guidelines in their dealings.
Okay, that makes sense. And what about the relationship between law and ethics? Are they basically the same thing, or is there a crucial difference there too?
Oh, there's a vital difference. Law is a system of rules that you must follow. It's enforced by government bodies, courts, police. It focuses on what must be done. Ethics, however, are moral principles that should guide behavior. They're often enforced by social pressure, professional codes, or just your own conscience. Focuses on what should be done. A clear example of where they overlap but differ is maybe predatory lending. Some forms might be technically legal, finding loopholes in the regulations, but ethically, most people would agree it's deeply wrong to trap vulnerable people in debt they can't possibly repay. So the law might not catch it, but our moral compass screams that it's unethical.
So legal doesn't always mean ethical.
Precisely. And you also have actions that are both illegal and unethical, like insider trading or outright fraud. To help navigate these tricky ethical situations, we have different theories that offer frameworks for decision-making. One really interesting contrast is absolutism versus relativism. Absolutism suggests that moral principles are universal. They apply everywhere, always, regardless of the context. Lying is always wrong, for example. Relativism, though, argues that what's considered moral or ethical depends heavily on the specific culture, region, or society you're in. Context matters.
Can you give us an example where that really plays out starkly in the banking world?
Yeah, the most compelling one is probably the charging of interest on loans. In conventional Western banking, charging interest is completely normal, ethical, standard practice. It's the basis of the business model. However, in Islamic banking, the charging of interest, known as riba, is considered unethical and is strictly forbidden under Sharia law. This isn't just a minor difference. It fundamentally shapes the entire structure of Islamic financial products, contracts, and the underlying philosophy. It's a prime example of how core ethical principles can be profoundly relative across different cultural and belief systems.
Fascinating.
Yeah.
So different ways of looking at what's right?
Right. And while there are many other theories, they often fall into two broad categories. Those focused on consequences, what results from the action, and those focused on duty is the action itself, right, according to some rule or principle. A consequence-based approach, like utilitarianism, asks that famous question: what action will produce the greatest happiness or least harm for the greatest number of people? Then you have duty-based approaches, like deontology, which argue that some actions are just inherently right or wrong, regardless of the outcome, because they follow or break a moral rule or duty, like do not lie. These frameworks aren't just, academic exercises. They offer really practical ways to reason through complex dilemmas you face every day in banking.
Okay, so these different theories can sometimes pull in opposite directions, right? Creating real tension when you have to make a decision. To help untangle that, what are some of the practical decision-making models people can actually use?
Yeah, that's where practical models come in handy. One straightforward one is Tucker's 5 questions. When you're facing an ethical choice, you ask yourself, is it profitable? Is it legal? Is it fair? Is it right? And importantly, is it sustainable? These aren't just simple yes-no questions. They really force you to think about the multifaceted impact of your decision from different angles. Another well-known one, the Blanchard-Peel framework, simplifies it even further to 3 questions. Is it legal? Is it balanced? Fair to all concerned? How will it make me feel about myself? These models don't just give you the answer on a plate, but they provide a really structured way to think through the ethical complexities and make sure you've considered multiple perspectives before you act.
Right. And sometimes just how important an ethical issue feels can drastically change how people react, can't it? This is where that idea of moral intensity comes in from Jones's theory.
Exactly. Moral intensity explains that the felt importance or urgency of an ethical issue isn't static. It's influenced by several factors. Think about the magnitude of consequences. How big is the potential impact, positive or negative? Or proximity? How close do you feel psychologically or physically to the people who will be affected?
So, if it affects your own team versus people far away.
Precisely. Or consider social consensus. Do most people around you agree that this action is wrong? And temporal immediacy. How soon will the consequences be felt? Imagine a potential whistleblower in a bank. The ethical issue of reporting misconduct would likely have higher moral intensity if the consequences of the wrongdoing were massive, say millions lost by vulnerable customers, and if the whistleblower felt a personal connection or responsibility to those harmed. The higher the moral intensity, the more compelled someone might feel to act, even if it involves personal risk. It helps explain why some ethical scandals cause huge public outrage, while others, maybe objectively just as serious, kind of fly under the radar.
Okay, that's really helpful for understanding the internal dynamics. Let's shift our focus now from internal ethics to the external guardrails. This raises a really crucial question. Why do we even regulate banks? What's the fundamental purpose of all that oversight?
Yeah, regulation in financial services is absolutely essential, and for multiple reasons. Firstly, and maybe most obviously, consumer protection. Regulations like Malaysia's Fair Treatment of Financial Consumers guidelines are there to safeguard customers from unfair practices, making sure they're treated justly and transparently. Secondly, and this is critical for the whole economy, is financial stability. Think about global frameworks like Basel III, which sets those capital adequacy requirements. These aren't just bureaucratic hoops to jump through. They ensure banks hold enough capital to absorb shocks, preventing a kind of domino effect that could potentially collapse the entire financial system. We saw the risks of that in 2008.
Right, so it's about protecting the individual and protecting the system as a whole. What other reasons drive all this regulation?
Well, beyond that, regulators aim to promote market integrity. That means preventing things like insider trading, market manipulation, keeping the playing field level, essentially. And a huge global effort, particularly post 9/11, is dedicated to anti-money laundering, AML, and combating the financing of terrorism. Legislation like Malaysia's AMLA 2001 is key here. These regulations are designed to stop banks from being used unwittingly or maybe even complicitly for illicit financial activities. Without this kind of oversight, the financial system could easily become a channel for crime and instability.
Okay, so we get the why, but how does regulation actually, take form? Are there different types or flavors of it?
There are indeed several forms. You have direct regulation, which are the rules imposed by government or specific regulatory bodies like Bank Negara Malaysia. Then sometimes you see deregulation, which is the removal or reduction of those rules. This is often done to try and foster competition or innovation, though it can have risks. Malaysia's interest rate liberalization back in the day is an example. We also see self-regulation, where an industry or profession sets its own standards, often through bodies like the Association of Banks in Malaysia promoting best practices.
And what about the way the rules themselves are structured? Are they always super detailed or are they sometimes more flexible?
That's a key distinction. Some regulations are very rule-based. They're highly detailed, specific, leaving very little room for interpretation. Think of a precise capital adequacy ratio. You meet it or you don't. Others are principle-based. These set out broad principles or desired outcomes, allowing firms more flexibility in how they achieve compliance. Bank Negara's fair treatment guidelines lean more towards principles. Often, in practice, you see a hybrid approach, combining specific rules for some areas with broader principles for others, trying to get the best of both worlds. Now, thinking about why these regulations come about in the first place, various theories offer explanations. The market failure model is a dominant one. It suggests regulation steps in when the free market, left entirely to its own devices, fails to produce efficient or fair outcomes. A classic example in banking is information asymmetry. The bank typically knows far more about complex financial products than the average customer. This imbalance can lead to problems like mis-selling or customers taking on risks they don't understand. So regulation steps in to mandate disclosure, simplify products, or set suitability requirements to protect the less informed party.
Okay, so regulators are stepping in to fix problems in the market. But I've also heard of something called capture theory. That sounds a bit more cynical. What's that about?
It is a more cynical view, yes. Capture theory suggests that regulatory bodies, over time, can become unduly influenced or even captured by the very industries they're supposed to be regulating. This doesn't necessarily mean corruption, but that the regulator starts to prioritize the industry's interests, maybe unintentionally, over the public good. A compelling, though debated example sometimes cited is the historical status of touch-and-go in Malaysian payment systems. For a long period, critics argued its near-monopoly position, potentially enabled by regulatory barriers preventing easy entry for competitors, might have stifled innovation and limited consumer choice. The argument was that this perhaps benefited the dominant player more than fostering a truly competitive market. It's a potent reminder that even regulators need oversight and scrutiny to prevent capture.
Right. And unfortunately, despite all these regulations and theories, we still see regulatory failures. What do those actually look like in the real world of banking?
Yeah, they manifest in several damaging ways. You have rogue trading, where maybe one individual or a small group within a bank makes massive, unauthorized, incredibly risky bets that end up causing colossal losses for the institution. Think Nick Leeson and Barings Bank or the UBS rogue trader. Losses can run into billions. Then there's market manipulation. This involves deliberately deceiving the market to artificially inflate or deflate prices for personal gain. Classic pump-and-dump schemes in stocks are one example. And insider dealing or insider trading. This is perhaps one of the most direct betrayals of market fairness, using confidential, non-public information to buy or sell shares, giving yourself an unfair advantage over everyone else. It's illegal and unethical.
And we've seen a particularly stark and globally significant example of regulatory failure recently, haven't we? With the 1MDB scandal.
The 1MDB scandal is indeed a chilling, large-scale illustration of systemic regulatory failure. We're talking billions of dollars misappropriated through a complex web of transactions. Compliance checks, oversight by boards, scrutiny by regulators, both domestic and international, were clearly inadequate or circumvented. The result was immense public financial loss, severe reputational damage to institutions involved, including major global banks, and a profound erosion of trust in the financial system and regulatory bodies worldwide. It really demonstrated how, even with regulations theoretically in place, breakdowns in governance, ethical conduct, and effective oversight can lead to absolutely devastating consequences for customers, taxpayers, and the integrity of the whole system. The fallout was massive, huge fines, criminal charges, increased regulatory burdens, and that deep loss of confidence.
Wow. So if regulation is that crucial external guardrail, then maybe corporate governance is the bank's internal compass. It's the system of rules, practices, processes by which a company is directed and controlled. And in Malaysia, we often look to the Malaysian Code of Corporate Governance, the MCCG, as a benchmark.
Exactly. And within corporate governance, a really foundational concept, particularly in Anglo-American systems, is agency theory. This theory views the relationship between the shareholders, who are the principals owning the company, and the management the agents hired to run it, as potentially having conflicting interests. The core issue is the principal-agent problem. Managers, who are supposed to act in the shareholders' best interests, might actually prioritize their own self-interest. This could be through excessive perks, empire building, or maybe taking excessive risks to hit short-term bonus targets, even if it jeopardizes long-term shareholder value.
Right. So it's fundamentally about making sure the people running the company are actually working for the benefit of the people who own it. How do you try to bridge that gap, address that problem?
Well, that's where agency costs come in, and mechanisms to reduce them. One key way is aligning incentives, tying management compensation to long-term shareholder value, perhaps through stock options that vest over several years, not just immediate cash bonuses, is a common approach. Increased monitoring, like audits, transparent communication, and strong board oversight also help reduce these agency costs. Now, contrasting with that is stewardship theory. This offers a more, perhaps optimistic view of human nature and management. It posits that managers aren't inherently self-serving agents, but are often intrinsically motivated to act as responsible stewards of the organization's resources, genuinely wanting to do what's best for the company. The benefits, if this holds true, are significant. It fosters greater trust between shareholders and managers, reduces the need for costly monitoring, and encourages that vital long-term planning perspective, which is absolutely critical for a bank's stability and sustained success.
Interesting contrast. Let's zoom in on board governance then. The board of directors plays several really critical roles, doesn't it? Leadership, setting the strategic direction.
Absolutely. And providing crucial oversight of management, ensuring risks are being properly managed. They also handle vital tasks like CEO succession planning, making sure there's continuity at the top.
Okay, and in terms of who sits on the board, you have executive directors, like the CEO, who are part of the bank's day-to-day management. Then you have non-executive directors, or NADs. They aren't involved in daily operations, but bring outside perspective and experience. But the really crucial ones, especially for governance, seem to be the independent non-executive directors, or INADs. What makes them so special, so important?
Their independence is paramount. An INAD must be completely free from any significant business, family, or other relationship with the company or its management that could potentially compromise their objective judgment. This independence means they can provide truly objective scrutiny and challenge to management decisions. They're not beholden to the CEO or internal politics. They act as key guardians of the interests of minority shareholders and arguably the broader public interest. They are an essential check and balance on executive power within the company. Their voice carries weight precisely because it's expected to be unbiased. And all directors, executive or non-executive, carry serious legal and ethical fiduciary duties. These are fundamental. The duty of care means they must act with the skill, care, and diligence that a reasonably prudent person would exercise in a similar position. For a bank director, this means understanding the business, asking tough questions, carefully reviewing risk reports, not just rubber stamping things. Then there's the duty of loyalty. This requires directors to act honestly and in good faith, always in the best interests of the company as a whole, and actively avoiding conflicts between their personal interests and the company's interests. These duties aren't optional. They form the ethical and legal bedrock of responsible leadership and decision-making at the board level. Got it. And to help manage risks effectively across the bank, organizations often use what's called the three lines of defense model. It sounds quite structured. How does it work?
It is quite structured, and it's become a standard model in risk management, especially in finance. It provides clarity on roles and responsibilities. The first line is basically business management and internal control functions. These are the people on the front lines responsible for identifying, assessing, controlling, and mitigating risks as part of their day-to-day jobs. They own the risk. The second line consists of functions like risk management and compliance. They provide oversight, expertise, monitoring, and challenge to that first line. They set the policies and frameworks and make sure the first line is operating within them effectively. And the third line is internal audit. They provide independent, objective assurance to the board and senior management that the overall governance, risk management, and internal control processes, including the first and second lines, are operating effectively. It's a layered defense system designed to catch issues before they become major problems. Okay, that makes sense. A system of checks and balances internally. So what does all this, the governance, the rules, the pressures mean when it comes to the sort of way things are done around here in a bank? We're really talking about organizational culture now, aren't we? Those shared norms, values, behaviors, seen and unseen, that truly guide how people actually work together.
Absolutely. Culture is often described as the invisible hand guiding behavior within an organization. It's incredibly powerful, sometimes more so than formal rules. One really insightful model for understanding culture is Shine's model, which breaks it down into three levels. At the very surface, you have artifacts. These are the visible, tangible elements, the bank's logo, the fancy headquarters, the formal dress code, the technology they use, even the stories people tell. Below that, you have espoused values. These are the stated beliefs and values the organization promotes, things you'd find in the mission statement, the annual report, the official code of conduct, like integrity, customer first, innovation. But the deepest and often the most powerful level are the underlying assumptions. These are the unconscious, taken for granted beliefs, perceptions, thoughts, and feelings. They're the unwritten rules about how things really get done, what's really valued, who really gets ahead.
And how does that play out specifically in a bank's ethical landscape? Where do things go wrong?
Well, a classic ethical risk emerges when there's a significant gap between the espoused values and those underlying assumptions. For example, a bank might have beautiful ethical slogans plastered on its walls. Those are artifacts. And a mission statement championing putting customers first. That's an espoused value. But is, beneath the surface, the real way to get promoted or earn a big bonus, the underlying assumption, is to meet aggressive sales targets, perhaps by pushing high-fee products regardless of customer need, then you have a major cultural conflict. This breeds ethical risks like mis-selling or churning accounts. We saw hints of this in the Prosper Bank case study mentioned in the materials, where the culture seemed to prioritize high-fee products over genuine customer service, illustrating that dangerous gap between stated values and actual behavior.
So the real culture overrides the official one.
Often, yes. Another useful lens is Deal and Kennedy's organizational culture model, which looks at culture based on two factors: the level of risk involved in the company's activities, and the speed of feedback on whether decisions were right or wrong. For instance, a work hard, play hard culture is characterized by low risk per activity, but fast feedback. Think of retail banking with daily or weekly sales targets. There's lots of activity, quick results. While this can create energy and focus, it can also, if not managed carefully, incentivize short-term thinking, maybe cutting corners or mis-selling, to hit those immediate targets like the pressures described at Horizon Bank. This model helps us understand why different departments or roles within the same bank might develop distinct cultural pressures and ethical risks. A training floor, tough guy macho, will have a very different feel and risk profile than a back-office processing unit, process culture. And ultimately, all these models, all these discussions about governance and rules really point back to the critical importance of the tone at the top. How senior leadership behaves, the ethical standards they visibly champion and adhere to, the values they actually embody through their decisions and actions. That's what truly shapes the entire organizational culture more than anything else. It sets the expectation, encourages ethical decision-making down the line, builds trust with employees and external stakeholders, and significantly mitigates risks across the board. It truly is the invisible yet incredibly powerful force guiding the bank from within.
That's really fascinating. And what's striking now is how the whole conversation in banking seems to have moved beyond just pure profits, hasn't it? There's this much broader focus on the impact on the planet and on people. We're talking about ESG, environmental, social, and governance.
Yes, ESG has become hugely significant. It refers to a set of criteria now widely used by investors and stakeholders to evaluate a company's commitment to sustainability and ethical practices, going far beyond just a traditional financial bottom line. The environmental ease assesses a bank's impact on the natural world. This includes its own operational footprint, energy use, waste, but maybe more importantly, how its financing activities impact the environment. Think about providing green loans for renewable energy projects like solar panels, or maybe refusing to finance certain environmentally damaging industries.
Okay, so that's the E. What about the S and the G?
The social S evaluates a bank's impact on society. This covers a wide range of labor practices within the bank, human rights considerations in its supply chain or lending, how it engages in local communities, and critically, its role in promoting financial inclusion. An example here could be developing accessible mobile banking solutions specifically designed for rural or underserved populations. And the governance G brings us back to those corporate governance practices we discussed. The board structure, executive compensation policies, shareholder rights, transparency, anti-corruption measures, essentially. How ethically, transparently, and accountably the bank is actually run. The growth of ESG is really being driven by increased investor demand. Investors want more non-financial information, they want to align their portfolios with their values, and they increasingly see ESG factors as material risks and also growth opportunities.
Right. But with all this focus on being green and socially responsible, there's also a risk, isn't there? The challenge of greenwashing, making things look better than they are.
That is a very real challenge, yes. Greenwashing happens when a company conveys a false or misleading impression about how environmentally sound its products or practices are. You might see a lot of slick marketing about green initiatives, but true greenwashing occurs when a bank's actions don't actually match its sustainability claims, or perhaps when they selectively highlight minor positive efforts to distract from larger, less sustainable aspects of their business. It undermines genuine efforts. That's why the concept of responsible banking aims to go beyond just ticking boxes or sick marketing. It means genuinely integrating environmental sustainability, social responsibility, and robust governance into the core strategy and operations of the bank. It involves actively combating financial crime, promoting transparency, and championing sustainability, not just as a PR exercise, but as a fundamental business imperative and a core value. And interestingly, in the world of Islamic banking, there's a unique and powerful framework that aligns closely with these ideas, called value-based intermediation, VBI. VBI takes the principles even further. It emphasizes that financial activities should not only be compliant with Sharia law, but should actively aim to create positive and sustainable impacts on the economy, community, and environment.
So it's not just about avoiding harm, but proactively doing good. Is that the idea?
That's precisely the idea. VBI explicitly encourages banks to finance projects that promote sustainable development, enhance financial inclusion for underserved communities, and strengthen overall ethical practices. The goal is to build stakeholder trust, not just through compliance, but through demonstrating tangible, positive impact. And proponents argue it also mitigates risks by encouraging more responsible, long-term investment decisions. Bank Negara Malaysia has been quite active in facilitating VBI, recognizing its potential synergy with broader ESG principles, even though VBI itself is rooted specifically in Islamic finance principles.
This all raises a really important practical question, though. How do banks, these huge institutions, actually address these massive sustainability challenges in a tangible, meaningful way? What can they actually do?
Well, they're engaging on multiple fronts, or at least they should be. Firstly, by aligning their own corporate strategies with major global frameworks like the UN Sustainable Development Goals, SDGs, and the Paris Agreement on Climate Change. This means publicly committing to shared global targets. Secondly, and perhaps most impactfully, they can help their clients transition to more sustainable business practices. This is done through things like offering preferential loan terms for green projects, green loans, developing sustainable supply chain finance, or creating social impact investing vehicles. And thirdly, promoting sustainable practices within their own operations is crucial too, focusing on energy efficiency in branches and data centers, reducing waste, ensuring fair labor practices for their employees. It's really about recognizing their central role and collaborating with governments, regulators, and other actors to build a more sustainable financial system overall.
Okay, shifting gears slightly now. The digital revolution, it has absolutely swept through banking, hasn't it? Bringing incredible opportunities, efficiencies, but also, it seems, entirely new ethical minefields to navigate.
Absolutely. The pace of digital innovation is staggering, and the ethical responsibilities that come with it are immense. For example, data privacy is a huge one. Banks now collect and process vast amounts of incredibly sensitive customer data. The ethical imperative, backed by regulation, of course, is to ensure responsible collection, transparent use, and rigorous protection of that data. Breaches can be catastrophic. Closely linked to cybersecurity, banks are prime targets. They need robust, constantly updated measures to protect customer data and financial assets from increasingly sophisticated cyber attacks. Failure here is a massive ethical lapse. But perhaps one of the most complex and emerging ethical challenges right now lies with artificial intelligence, specifically AI bias.
Right, tell me more about AI bias. How does that actually manifest itself in banking? What are the dangers?
Well, AI is increasingly used for critical decisions, credit scoring, loan approvals, even fraud detection, and potentially recruitment. The danger arises if the algorithms are trained on historical data that reflects past societal biases, for instance, data showing lending discrimination against certain racial groups, genders, or geographic areas. If that biased data is fed into the AI without correction, the algorithm can unknowingly learn, perpetuate, and even amplify those historical biases. This could lead to systematically unfair loan denials or offering worse terms to certain demographics, even if there's no conscious discriminatory intent. So ensuring fairness, transparency, and careful auditing of AI systems for bias, alongside a commitment to responsible innovation that aligns new tech with societal values and considers impacts like potential job displacement due to automation, these are absolutely critical ethical considerations for banks today.
That's a really sobering thought about AI. Another big buzzword in this digital space is open banking. What exactly is that, and what are the key ethical implications we need to be aware of?
Open banking is a framework, often driven by regulation, that allows third-party financial service providers, think fintech apps, to access consumer banking, transaction, and other financial data held by traditional banks. This happens via secure application programming interfaces or APIs, but crucially, only with the customer's explicit consent. The potential benefits are pretty clear. It's designed to drive increased competition in financial services, offer consumers more choice and convenience, like seeing all your accounts in one app, and potentially boost financial inclusion by enabling new, innovative services tailored to specific needs.
Okay, that sounds great for consumers in theory, more choice, more convenience. But it must come with some pretty serious risks too, right? Especially around data.
Well, absolutely. The risks are significant. The most obvious ones revolve around data security and privacy. Granting third-party access, even with consent, inevitably creates more points of potential vulnerability for data breaches or misuse. How secure are these third parties? There's also the risk of increased financial fraud, like identity theft, if data falls into the wrong hands, and a more subtle risk is potential consumer exploitation. Could less reputable third-party apps use access to your detailed financial data to engage in predatory lending or target vulnerable customers with unsuitable products? So the ethical responsibilities here are absolutely paramount. Banks and third parties need to ensure absolute transparency about how customer data will be used. There needs to be clear accountability for data handling and security. Systems must be designed for fairness, avoiding bias. Customer privacy and explicit, informed consent must be central, and robust security measures are non-negotiable. It's a delicate balancing act between fostering innovation and ensuring rigorous consumer protection.
Makes sense. It's a complex trade-off. Okay, let's maybe bring it back now towards the end to some of the more perhaps common or fundamental unethical behaviors and financial crimes that banks constantly have to be vigilant about and combat.
Yes, absolutely. Beyond the big systemic issues and digital challenges, there are still those core unethical acts that erode trust at a fundamental level. Irresponsible lending is a persistent one. Knowingly approving loans for borrowers who clearly lack the realistic ability to repay. This can easily escalate into predatory lending, trapping vulnerable individuals in cycles of debt with exorbitant interest rates or fees. Then there's simple dishonesty, like falsifying documents or misrepresenting information, as we saw on a massive scale in the Wells Fargo scandal, or a lack of due care, skill, and diligence, basically negligence. Ignoring clear warning signs, failing to do proper checks, which contributed significantly to the 2008 financial crisis, and mis-selling remains a major concern, pushing financial products onto customers who don't need them, don't understand them, or for whom they are entirely unsuitable, often driven by sales commissions. The Payment Protection Insurance, a PPI scandal in the UK, is a colossal historical example of this. All these stem from a fundamental lack of integrity, whether it's putting profits ahead of customer welfare, accepting bribes, or engaging in things like insider trading.
Right. And specifically here in Malaysia, the Competition Act 2010 also plays a crucial role in preventing certain types of unethical behavior by banks, doesn't it? What does it primarily focus on?
Yes, the Competition Act is important. It primarily prohibits two main things relevant to banks. First, anti-competitive agreements between banks, things like colluding to fix interest rates or fees, price fixing, or agreeing to divide up markets or customers amongst themselves. These practices harm consumers by reducing choice and inflating costs. Second, it prohibits the abuse of a dominant position. If a very large bank holds a dominant market share, it's forbidden from using that power unfairly, for example, by engaging in predatory pricing, selling below cost, just to drive smaller competitors out of business, or imposing unfair trading conditions on customers or suppliers. Essentially, in the end, to ensure a level playing field and fair competition, which ultimately should benefit consumers through better prices, innovation, and service quality. And then, of course, banks are right on the front lines when it comes to combating major financial crimes. Money laundering is a huge focus globally. That's the whole process of disguising the origins of illegally obtained money, drug money, corruption proceeds, etc., to make it appear legitimate. It typically involves three stages. Getting the dirty cash into the financial system, for example, small deposits. Layering. Conducting complex transactions to obscure the audit trail, for example, wire transfers through multiple accounts. And integration. Bringing the cleaned money back into the legitimate economy, for example, buying property or businesses. Closely related and equally serious is terrorist financing, providing financial support through whatever means to individuals or groups involved in terrorism.
And there are international bodies heavily involved in setting standards for this, right?
Yes, the key global body is the Financial Action Task Force, FATF. It sets international standards, its famous 40 recommendations aimed at preventing money laundering and terrorist financing. It strongly advocates for a risk-based approach, meaning banks need to identify and focus their resources on their highest-risk customers and activities. Banks also have to comply strictly with international sanctions regimes. These are measures imposed by countries or bodies like the UN against specific countries, entities, or individuals deemed threats to peace and security. Violating sanctions can lead to enormous fines, asset forfeiture, and even criminal charges for the bank and individuals involved. And finally, although maybe less dramatic, banks also play a role in preventing false filing of tax returns. Individuals or companies trying to evade taxes by misreporting income or fraudulently overstating reliefs often use the banking system. Banks have reporting obligations here too. Failure to file or filing falsely carries serious penalties.
Okay, so lots of external threats and crimes. But what about ethics within the bank workplace itself? It's not just about how banks treat external customers or fight crime, is it? The internal environment matters hugely too.
Absolutely. The internal culture and ethical climate are critical. Bullying and discriminatory behavior are serious issues that can poison a workplace. Bullying isn't just obvious physical aggression. It can be persistent mental aggression, spiteful comments, mockery, setting impossible deadlines, deliberately undermining someone, or victimizing them. Discrimination based on race, gender, religion, etc. is equally unacceptable and illegal. Banks absolutely need clear, enforced, zero-tolerance policies for such behavior. And critically, employees who experience or witness it need to feel safe and empowered to take action, documenting incidents, retaining any evidence, and reporting it through confidential channels without fear of retaliation. Creating a respectful, psychologically safe environment is an ethical imperative for employers.
And that leads us naturally to whistleblowing, doesn't it? When employees do speak up about wrongdoing.
Exactly. Whistleblowing is the voluntary disclosure by an employee or former employee of information about wrongdoing within the organization, things like fraud, corruption, regulatory breaches, safety violations, or serious misconduct. It's absolutely crucial for accountability and integrity. Whistleblowers often act in the public interest, bringing to light issues that might otherwise remain hidden, preventing harm to customers, shareholders, or the public. It promotes fair practices and holds organizations accountable. Recognizing its importance, Malaysia has the Whistleblower Protection Act 2010, WPA 2010. This law provides significant legal safeguards for individuals who make disclosures about improper conduct in good faith to enforcement agencies. Key protections include confidentiality of the whistleblower's identity, protection from detrimental action like dismissal or demotion in retaliation for blowing the whistle, and immunity from civil and criminal action for making the disclosure. It's designed to encourage people to speak up. And ultimately, underpinning all of this, preventing unethical conduct, fighting financial crime, fostering a good internal culture, is the critical role of robust internal control within banking. These aren't just isolated procedures. They are comprehensive systems of processes, policies, practices, and organizational structures designed to provide reasonable assurance regarding the achievement of objectives. That means safeguarding assets from loss or misuse, ensuring the accuracy and reliability of financial reporting, promoting operational efficiency, and ensuring compliance with all applicable laws, regulations, and internal policies. They are the essential internal fortifications that work alongside external regulations to maintain integrity.
Wow, okay. We have covered a tremendous amount of ground in this deep dive. It's quite a journey. From the absolute fundamentals, the basic purpose of banks, all the way through to these complex ethical theories, the sprawling regulatory landscapes we navigate, the critical importance of corporate governance, that huge modern push for sustainability and ESG, and right up to the cutting edge of digital ethics with AI and open banking. It's really a lot to take in.
It really is, and I think this raises a really important question, maybe a final thought for you listening. As you reflect on this whole journey through the world of banking ethics, just consider how your own choices as a consumer, choosing where to bank, as an employee working within the system, or as an investor deciding where to put your money, how those choices can actually contribute actively to fostering a more ethical and sustainable financial system. Every interaction, every decision you make, however small it might seem, plays a part in shaping this moral landscape of money, perhaps more than you realize.
That's a powerful thought to end on. We really encourage you to continue your own deep dive. Maybe look up the AICB Code of Conduct yourself, explore the latest ESG or sustainability reports from the banks you use, or just take a moment to reflect on how your own personal values align, or maybe don't align with the financial institutions you engage with every day. There's always more to learn, always more to uncover in this really fascinating and incredibly important space where money meets morals.